So derivative stock options, you can be either a call buyer or a call writer, or you can become a put buyer or a put. So we are going to discuss, first a call option where a person buys a call and somebody writes it. So again, X is a trader. So call option, you're a trader. On 2nd of January 2024, so he wishes to buy 10 lots of Reliance Industries Limited call option as is bullish on the stock. So the person is bullish on Reliance. Now, how do you know that you're a bullish or bearish in Reliance? It all depends upon the technical analysis. And though I wanted to give some knowledge about technical analysis, of course, I'll just cover maybe in next class. So there are certain, first of all, we must know there are certain indicators in technical analysis. Markets can be either trending or can be consolidating. There are two, ways that market can move. Either the market is trending or the market is consolidating. So I'll just, try to find out the slide which I have got. A little bit of knowledge of that, but more in detail later on. Now, is the market trending or trading? Yeah, this is a very important question, a person know before he enters into a trade, into future and options. Is the market trending? Trending means whether it is going up or going down, or it is, oscillating between a range. Now, Nifty is currently around close to about 21,000, 22,000. It is expected, we don't know, but it is expected that in next 3-4 months, before the elections results are announced, the market will be range bound. This is what is the general expectation. Market can always go up. It has its own mind. So, but it is believed that market may now range bound. It is priced in everything. The market has already touched, the new highs, and every day it was touching a new high. So it has covered most of the fundamentals. Till election, all the fundamentals have been priced in. It has priced in that, NDA is coming with majority. It is also priced in all the future profits of all the companies which they will make. So it's fully priced, what some people say. And now, only as the time goes and as the results are announced for this quarter and next quarter, of course there is some general belief that the 2 quarters which are remaining may slow down a bit. Okay, that is the economic belief. But India is largely insulated, and they say that they will do well. India is going to do better than rest of the world. But still, it won't be like, what we have achieved in the first 2 quarters for most of the companies. So the profits may be muted, maybe a little bit. So the market will remain range bound in the coming months. Neither it will go up nor go down. It will remain in a range between, say, 20 to 22,000, for example. So let's say it is trading. When we say it is called trading. It is not trending. It is trading. It's consolidating at that level. So when the market is trending, the market is either going up or going down. Fine. So how do we know that, market is either trading or trending? So there is one, indicator which tells you that. And that indicator is called ADX. So ADX is an indicator, average directional index. So that, I'll share these slides with you also. So this, indicator tells you whether the market is trading or trending. Okay, fine. So let's just go to straight away to, the indicators final, findings. There is a chart which says the index, this, indicator hovers between 0 to 200. Okay. How it is made, I'm not discussing at the moment. The index is between 0 to 100. Okay, fine. If it is less than 20, there is a weak trend and consolidation phase. That means market is, if it is at a very low level, the market is consolidating. It's not trending. Okay. If ADX is rising from 15 to 25, which means the trend is strengthening. That means the trend is gaining momentum. Now, which way? It doesn't tell you. Whether the market is going down or going up, it doesn't tell you that. Okay. But, it reaches maximum to the 40 level and then it falls down. Okay. Fine. So a low reading of index, ADX tells you the market is consolidating. A level from, say, 15 and then moves up to, say, 30, 40, it is peaking out. The trend is peaked out. Okay. And then the consolidation begins again. Okay. So, it's like this. If you see a chart of a stock chart, which is on the top and ADX is the bottom, you can just see, whenever the ADX is down, small range, Then see the chart, it is in consolidation phase. And you see the extreme sides of the ADX, it is above a certain level, 2015. The market is, look at the right hand side, the market has started going up. Fine. When the ADX is also going up. It can even, it can even go down also. So ADX doesn't tell you the which direction, but it tells you the market is trading and trending. Okay. So first, you must know whether the market is trending or trading. Once you have identified the market is consolidating, that can be one. Second would be market is trending. Once you know that, then you can apply indicators, the suitable indicator for understanding the movement of the stock. It doesn't tell you the movement of the stock, but it tells you. So there are, two types of indicators. One is called the trend following indicators. If the market is trending, you follow the trend following indicators. Otherwise, follow, if the market is not trending, follow the other indicators, which are range bound indicators. Okay. Normally, people will only take a position when market is trending. The right time to take a trade is whether you buy a call option or a put option or go long on futures would be in the market is trending. Fine. Now, after knowing the market is going to fall, you will sell a call or you will sell futures. Fine. So, there are two kinds of indicator. One are called the trend following indicators. And the two important indicators are moving averages and MACD. So I'll just show you a little bit on the screenshot, this thing, on the live, this thing. We go to the, site and go to screener. And take, for example, any stock like Maruti, for example. Okay, there is a chart and there is a chart here. Fine. This chart is telling you the price trajectory of the Maruti. So this is a 1 year chart. Okay. If you look at the movement of Maruti, it was rising for most of the year, but then it started falling in the recent times, isn't it? It has been going up, up, up. So almost it has gone up by 20% in the whole year, and then corrected by about 3 to 4%. Okay. So, and the bottom of the chart, which is you find histograms, they are the averages, how many people have bought. That is telling the volume. So there is a price and volume chart in your screen. One is how many people are buying and how many people are selling. There's a volume of that, which is on the horizontal axis, x-axis, and then the share trend is shown. Is that okay? Fine. So price and volume are very important thing in technical analysis. Then what we do is we calculate the 50 DMA and 200 DMA. These are moving averages. Okay. Fine. So I plot them here. So I plotted two kinds of moving averages. Okay. The red one is called 50-day moving average. And the greener one or black one is called the 200-day moving average. Okay. Daily moving average. So it's like this, suppose you have to say 10 days. You take the total of 10 days prices, divide by 10. So you'll have one 10-day moving average. Then you ignore the first one and add the new one. And you draw a line like this. So it will be a 10-day moving average. Similarly, 50-day moving averages. For 50-day moving average, you have to take 50-day stock prices of every day, total them and take an average. Okay. So you'll get one plot. Then on the next day, take that number and ignore the last number and draw a line. So it will become 50-day moving average. And 200-day average can be done on a 200-day moving average like that. Okay. So 50-day moving average and 200-day moving average tells you the long-term trend of the stock. You can take 30-day moving average and 10-day moving average also. It tells you the short-term, trend of the stock. Now these averages can be only used when the ADX says the market is trending. If the market is consolidating, then you can't use it. It will give you false signals. Whenever the 50-day moving average is above the 200-day moving average, the stock is bullish. Okay. Whenever the short-term moving average is above the longer-term moving average, the market is going to rise. It's a lag indicator. There's no indicator which tells you, advance. It tells you after the move has begun. Now look at this thing. When the 50-day moving average crossed over the 200-day moving average, the stock started going up. And whenever the 50-day moving average was below the 200-day moving, the stock was down. Can you see that? So here, most of the year, the 50-day moving average was above the 200-day moving average, and it's a bullish trend. So as long as it remains so far, even the Maruti has corrected, but the 50-day moving average is still above the 200-day moving average. That means the long-term trend is still intact. But the story can be different if you see the 10-day and 30-day moving average. Maybe the 10-day moving average is dipped below the 30-day average. Short-term trend of Maruti is down, and we can go to a more precise charts where all these averages can be known. Okay, just hold on. So first of all, as a investor, as a long-term investor, if you are buying the stocks for the long term, then rely on 50-day moving average and 200-day moving, because it is telling you the stock trend is up. But if you are a trader, then 50-day and 200-day moving averages almost become meaningless for you. Then you should look for a smaller moving averages. So next time I'm going to show that. Okay, there is a site which gives you a much smaller this thing. Okay. Okay, 5 years. So that is what I wanted to do. Okay. So look here. So here, the stock, of course, it's a 5-year. Okay. So in the last 4 years or 5 years, Maruti has not given enough returns. It has given only 29% returns, or even less than that. You can just check. Just hold on. No, I just wanted to show you that, of course, the stock is in a very bullish mode. Last 1 year, if you see the return of Maruti, it's about 18.9%. Fine. This is just a month-old chart. And after that, there has been some correction. And 5-year, the return has been around 29%. Not per annum. For 5 years, you have got an absolute return. The stock was lying low. Okay. If you can see the chart, it was not moving up so much. It has moved up, but close to about 30% return in last 5 years. So almost like 5 to 6% return on an average per annum. But last year, it has moved up. And the analysts are very bullish on that, this stock. And they've given score of 10 out of 10. And the rating is buy rating for Maruti. Okay, for long-term people. So coming back to the chart again. So here, you find that, most of the time, the 50-day moving averages was down. Okay. At many times, the stock was correcting. Okay. Then again, the moving averages was going up 50-day. Stock was rising a bit. And then again, whipsawing. So this was a kind of a consolidation phase of Maruti. So in a consolidation phase, the moving averages don't give you the right picture. Fine. So you can't rely on a moving average if the markets are consolidated or stock is consolidating. Now in a 5-year chart, the Maruti is consolidating. Only just recently in the last year, if you see clearly that the stock has, the moment, there is a crossover. 50-day moving crossed over. Just look at the screen at the end. One crossover hua, or Maruti started going up. And that is called the golden crossover. Particularly when it is a 50-day and 200-day moving average. Like for example, Nifty, 50-day moving average crosses 200-day moving average, the bull run has begun. Okay, it's called the golden crossover for stocks as well as for the market, for Nifty or Sensex or whatever. Okay, fine. So the golden crossover has already happened, about a year back in case of Maruti. And of course, there is some, intermediate correction which is happening currently because the stock has moved so fast that, then the correction sometime happens to, it has run ahead of the fundamental. The first 2 quarters are very good for Maruti. It has done record sales. I'll just show you. Look at this quarters. Or look at, the profit loss account, okay? The TTM, which is the trailing 12 months. That means the second 6 months and the earlier first 6 months. Last 12-month number. Look at the sales, how it is going. 70,000 to 88,000. 88,000 to 1,17,000, then 1,30,000. So sales are moving like in a blistering pace, and the profits have also gone up, zoomed past. Net profit has gone now showing it touch about 11,000 crores for the last 12 months, whereas it was lying at around close to about 3,800 crores. So in the last, 3 quarters, the stock has done very good, and their profits have almost tripled in this thing. But Maruti itself has said in their annual report, the next 2 quarters are going to be very bad. Not very bad, but not as good as what they have witnessed. because of some reasons which they have mentioned in the annual report. Last time I had played out that reason. I'll be putting a video on that shortly, maybe tomorrow on Maruti, because I've done a class. So anyway, so let's come back to the derivatives, and I'll just complete what I was saying. So they are indicators, moving averages. That is one indicator. That only gives you the right amount of information for taking a call or put option or whatever in your trading options. Only a short moving averages like 30-day versus 10-day moving average are more relevant rather than 50-day or a 200-day moving average. Okay. Now it's a lag indicator. That means if you look at Maruti. Okay, we go to the chart again and look at the for example 3-year chart, for example. Now look at here, the golden crossover happened. Okay, but actually the move have of if you look, the moment the 50-day moving average crossed over the 200-day moving average, the stock started going up. Okay, but generally the moving averages crossovers, and the much later than the stock market, the Maruti would be started going up, and after a few weeks you will find the confirmation given by the moving averages that the bullish run has begun. Okay, fine. Because moving averages are basically lag indicators, because it's giving you an average of 200 days and 50-day average. So they are slow moving averages. Okay, they move slower than the actual price. So they will tell you the story only once the move has already begun. Okay, so almost for 2 weeks after, they will tell you that stock is on the uptick, whereas stock has already gone up a little bit. Already 10% stock or 5% stock has gone up, and now it is confirming that now we are a bullish wicket. Okay, so then people said, okay, this is telling you much later. So there's another indicator, is called MACD. Okay, the MACD tells you almost like after 3 days only the stock has moved, is going up or going down. Okay, so that is a much faster indicator, which tells you the stock is moving. It's also a lag indicator, but with a very less lag time. This will give you information after 2 weeks after the move has happened, but that will maybe tell you after 3 or 4 days that move has happened on the uptrend. So I'll show you what is MACD, but next time. Okay. Anji? ADX indicators, there are softwares there. If you go to the site, you'll find ADX. You search for technical indicators, you'll have online sites. There are some free sites you can go and just find out. There is a site called Stock Charts, which is a foreign site which also gives Indian indicators also, ADX and everything. And all the charts are, you can see, and it is a free site. For some, some data is given, but then if you pay some money, then you have more elaborate reading on that. But there are some free sites also you can check. Okay. If the market is trending, these indicators. If the market is range bound, then you use oscillators, stochastics. You know what happens? Some people, they can't live without stock markets, because 60% time markets are consolidating, 40% time the markets only are trending. So they still want to play. Okay. So then they have to find, when the market goes up and goes down, it's not like the market is falling. If it's the consolidating, that means the Nifty will be, ranging between 18,000 to 20,000, for example, or 22,000 to say 20,000 to 22,000. Suppose that's a range for the next few months. So they'll say, okay, first of all, we have to find the range. So that indicators will tell you the range. The market is range bound, and Nifty is going to be between 20 to 22,000. Okay. Now, the moment it reaches 20,000, they will buy. That is the oversold situation. The oscillators will tell you, or the the stochastics oscillators will tell you when the market is oversold, and then at what level the market is overbought. And from the overbought, it will start again falling back to 20,000. So they buy at the bottom, and they buy at 20,000 and exit the position at 22,000. Okay, so they still make money. So you can always use, even in the market when that's consolidating, people use oscillators like stochastics, and they find the two ranges, the lower range of the market and the upper range of the market. At lower range, they'll buy, and upper range, before it reaches upper range, they'll sell and book the profits in between. हाँ जी, हाँ RSI भी हो गया, RSI relative strength indicator. So these are stochastics basically. Okay, so once you have found the market is trending, then you rely on moving averages and MACD, which I'm going to discuss next time. Fine, so we're not discussing. So let's understand abhi, Ashna, please listen. Okay, you came late. Okay, so we are just starting. We are not. We are just deviating from something else. So this is the first slide we are doing. Okay, so we are buying a call option. So what we are doing? Call and put options. So X is a trader, and on 2nd January 2024, X wishes to buy 10 lots of Reliance Industries call option. He is bullish on the stock. So he's buying a call option because he is bullish. He knows that the stock Reliance will go up and he'll make a profit. Reliance call option currently trading at a CTM means close to money or near to money, or ATM. I was putting a word ATM. Close to money, very near to the current stock price. Reliance call money currently trading at CTM strike price of 2580 at 60.15. 60.15 is the premium. If you use a strike price 2580, because if you see at the bottom, the spot rate is 2578.30. Okay, so this guy chooses a strike price of 2580, which is very near to the money or at the money, which we say CTM, close to the money. The Stock Exchange of India NSE uses the word CTM, and he places a limit order which gets executed. Expiry on 25th of January 2024. Lot size is 250. So he must pay an option premium of 60.15. I have to make a correction, into 2,500. So that means he pays a premium of 1,50,375. So that means the premium was 60 rupees 10 paisa. Okay, not 15. So I should make a correction. So he says that, okay, that the Reliance stock is going to go up. Okay, and the market is trending according to the technical analysis. He has used the indicator called MACD. Okay, and he found the Reliance is going to go up. Okay, we'll understand what is MACD next time. So he says that stock is going to go up, so he buys a call option. So he'll make money if the stock price goes up. Okay, now these were the all the strike prices which are available. So what strike price we have chosen? 2580, isn't it? And what is the premium? 61.20. Okay, by the time I was just changing this thing, the prices were going up and down. So I captured this thing and then I captured the screenshot where it was showing 61.20. So for the strike price of 2580, the premium was 61.20, but this happened in few minutes, seconds, and by the time I took a screenshot, the price has gone up. Okay, fine. So he has taken a position. How many lots? 10 lots. Of course, you can always put 10 and get a limit price at 10 and you will get the price. Okay. Now, these are all the, the bid and ask information which is available. I'm just skipping at the moment. I'll come back to this. Okay. So he bought 2,500 Reliance at a strike price of how much? Haji? 2580. Okay. And he had to pay a premium of 60 rupees 15 paisa. Okay. So the margin required is nothing but the premium, which is 1,50,375. So if you go back there, so that was the premium he paid, isn't it? Fine. Chalo, okay, we aate hain. 3rd of January. Now what happened? He booked the order on which place? Date? 1st of January. Hai na? Now 3rd of January he checked his again position. Reliance on 3rd of January opened at 2612. Thus going up from 2578. Up by 32 days in a day's time. 32 रुपए एक ही दिन में Reliance had gone up. Okay, fine. Reliance call. Now this is the spot. This is the price, the cash segment price of Reliance, which was trading at 2612. तो 2578 था, तो 2612 पे पहुंच गया. उसके बाद from 2578 it went up to 2612 in a matter of just 2 days. Okay. 32 रुपए gain हो गया. If the underlying price goes up, the premium also goes up. Okay, because the premium will vary because of the volatility. If the volatility goes up, premium will go up. Similarly, if the underlying goes up, the premium will also go up. So he checked the premium. Reliance call option currently trading at a strike price of 2580 at 78.60. So पहले कितने में trade हो रही थी? 61.15 or something. Okay. Now it was trading at 78.60 in a January contract. Same. Within a matter of 2 days, he found that the call option premium has gone up. He is making a profit of how much? 78.6 minus 60. That means difference is 18.4. Here we don't look at the price of the Reliance, we look at the premium difference. Okay. If you want to close your position well before the expiry, on the expiry the Reliance price will matter. But before the option expiry, because in India we are having European options, we can't close the position, okay, on the underlying price. Okay, so what we'll do? He closes his open position by selling a call at a strike price of 2580. What he did was, he wrote a call at the same strike price and he collected 78.60. Premium is same. Either you buy a call or write a call. When he bought a call, the premium was 60 rupees 50 paisa. When he sold the call, the premium was 78.60. By doing so, his position is closed and he is sitting on a profit of how much? Now he collects a premium of 1,96,000. Earlier he paid the premium, now he collects it. He becomes a call writer. Earlier he bought a call. So he was sitting on a profit of 46,125. Okay, so this is a new thing. How do we exit a call option? In case of a futures, we square up the position by taking an opposite position. If you have bought futures, you sell futures. But in case of options, you can't do that. You can do only, your position will get expired on the expiry day. Whatever the position of Reliance, the difference will be your profit. But before that, you can, if you have bought a call, you have to sell a. First you paid the premium, now you're going to collect the premium. The difference is your profit. Now tell me how much rupees the Reliance has gone up? 32. And how much the premium has gone up? 18. The premium is not going along with the price. It is not like 32 rupees premium, it has gone up. If you close your position at the end, you would have made 30 rupees profit. But that is not the luxury you get when you're in a call option. The premium is almost like, suppose it's half, 50%, okay, or 45%, or more than 50%. So 18 into 36. So almost 60% the premium has gone up. Fine. So we'll understand, this phenomena. So the premium has gone up to 46. He has made a profit of how much? 46,125. Thus he makes a return of 31% on his investment. How? He gained 46,000. He deposited initial premium of 1,50,000. So he makes a 31% profit and he closes his position. Is that okay? So when you have to exit, you have to, if you have bought a call, you have to write a call at the same strike price. You can't have a gap. Only when you have a bull call spread, there you can always go up and collect premium. So that was a different strategy. Here, you have to close the position at the same strike price in the same month. You have to, if you have bought a call, you write a call and you gain. Okay. So this is one. Now on 25th of January, now suppose he doesn't closes it. On 25th of January, just few days before the expiry. On expiry, the physical settlement will come into picture. Okay, fine, because it's a stock. So Reliance Industry closes on 25th of January 2024. The expiry was what? 25th January, I believe. Okay, let me just check. Expiry 25th. So it's expiry day only. Okay, let's go to the expiry day. Let's see. Reliance Industry closes at 2450 in the capital segment of the market, and X does not close his position. So what was the level of Reliance when he? So his option expires worthless. So in this case, there is no physical delivery. Only in the money options are attracting physical delivery. If your option is in the money, then only the physical delivery happens. Here what will happen? Because the stock has fallen down, so the person who has taken a long call, he loses his premium and the premium becomes the profit of the call writer. So the matter is over. X makes a loss of 1,50,000. So here the physical delivery will only be attracted when it is in the money. If the call closes in the money, that means you are making a profit. Here you are making a loss, then there is no physical delivery. Have you got it? So here, his premium is gone, and the option writer had made the money. Let's not discuss about the case where there is a physical delivery. Reliance Industry closes at 2680 in the capital market segment, the second case, and he does not exercise his option. अभी ये option नहीं करा इसने. He wished to take the delivery of Reliance, okay, and deposit the full amount as margin money between E4 to expiry day. So just before the expiry, 4 days before the expiry, he'll get call from the stock exchange that deposit money. Deposit 25%. E3, deposit 50%. E2, deposit 80%. Last day, deposit 100%. So within a matter of 4 days, has to deposit more and more money. Okay, because he has not told anything to the exchange, he's not closing the position. He can close the position. Okay, even before the E4, before the expiry, but he has to keep paying the margin. Fine. But he's waiting. Suppose the stock goes up, then he can close the position, he'll get all the money back. But he never closes because the Reliance is closed at 2680. Below he requests a physical delivery at 9 a.m. He has to request a physical delivery between 9 a.m. to 11 a.m. on the expiry day. Fine. So he has taken the position at what price? 25? नहीं. 2580. 2580 पे था ना. अब ये प्राइस कितने पे क्लोज हुआ? 2680. So it's in the money. He's sitting on 100 rupees profit, isn't it? Maybe on the expiry it went 100 rupees. 2 days before the expiry it went to 100. So it is in the money. So the delivery, provisions will apply now. So he says that I'm going to take the delivery. He has bought it, so he has to take the delivery. He wishes to take the delivery of Reliance. He requests for physical delivery between 9 a.m. to 11 a.m. on the expiry. That's the time when he has to request to the stock exchange. Between this time, 9 a.m. to 11 a.m. in the morning on the expiry day, he has to inform the stock exchange that I'm going to take the delivery and I have already deposited the money. And he has to make sure that all the 100% money is deposited. Mr. X will get the delivery of Reliance on 25th January 2000 in his demat account. He has paid all the amount, okay, and he has requested for physical delivery.